Now, to balance that out, I wanted to give 6 cons of a diversification strategy. Okay. Now, the first con of the diversification strategy is that it naturally limits your growth opportunities. Well, of course it does, right? And I'll tell you exactly how. Okay. Let's just use a very basic example. Okay. If last year, right, 2020, in January, I had, a portfolio that was half Tesla and half AT&T, right? AT&T is a very stable stock. It doesn't go up in value by a ton. They pay a big dividend, right? It's not a growth company by any means, right? But I put half of my portfolio there and I put half of my portfolio in Tesla, okay? The Tesla portion of my portfolio since that time has absolutely skyrocketed. Hundreds of percent of growth since just last January, okay? But the AT&T portion, right, it's grown, but it hasn't grown to an outstanding extent, right? And I could have made dividends off of it, which would have been beneficial, right? But the growth would have come basically from the Tesla portion of my portfolio. But if instead of half and half, I held the entire portfolio in Tesla, right, then you would have made the full returns of Tesla, right? You would have just made the Tesla returns, which would have increased the growth opportunities that you had. So every time that you try to diversify a little bit with adding another stock, it takes away from the ability of one particular company and their growth to be able to shoot your growth opportunities upward, right? It takes away from the fact that Tesla made hundreds of percent if you own something in your portfolio that lost money over the last year and a half, right? It naturally is going to limit your growth opportunities, which is a big reason why a lot of people do not like diversification. Then the second con to diversification is that even diversification can lose money over time. Many investors will have bonds in their portfolio to help offset broad declines in the stock market that may happen. The only problem with this is that even municipal bonds, which are about as much of a sure thing as one can get, can lose money if their credit status changes or there are suspicious activities taking place which require an investigation. So even within a diversified strategy, you can lose money, right? Even if you own the S&P 500, right? The S&P 500 has had several drops of 30, 40, 50% plus over its lifetime. So that can absolutely happen to you. And if you own like balanced funds or things of the like, and let's say interest rates rise, well, what happens when interest rates rise? Bond prices fall, right? And when interest rates rise, what else happens? Well, stocks don't necessarily like that because companies can't borrow as cheaply, right? So even a diversified portfolio can lose you money over some period of time. Then, third con of a diversification strategy, some ETF investments for diversification are too diversified, right? And you could argue that a bunch of mutual funds are as well, where they hold thousands of companies, right? We read earlier and we talked earlier about how 25 to 30 stocks is really where the main benefit from diversification stops. So why would you add thousands of companies to a portfolio? Or many may argue, why would you even buy an S&P 500 portfolio that has 500 companies in it, right? Because that is maybe too diversified. Investors need to always be wary of anything that seems too good to be true when they're looking to diversify. Some alternative mutual funds can perform very well because when asset classes are tracking too many different assets, then the cost of investment becomes problematic, right? So you always need to take that into account and understand that you can be over diversified. Then the fourth con, there can be unexpected tax complications. If you're investing into gold ETFs, for example, then the returns that are received from the buying and selling process are taxed at capital gains rates. Other income may only be taxed at the 15% rate or the 20% rate, depending on personal income tax levels. That's why the best advice when it comes to diversification is to not invest in something that's not completely understood, right? So you need to invest in what you understand and understand the tax implications of the diversification that you're doing. Then, fifth con, it adds complexity to the investment process. If you have $200,000 to invest, then it's much easier to dump that money into just one investment, right? Now, obviously, you can invest into one diversified mutual fund or one diversified balance fund or whatever it may be, right? But if you break it up into 10 investments of $20,000 each, then you've got 10 companies where you've got to perform your due diligence. You've got to do the research. This means that not only is there an added complexity to the portfolio, but there are likely to be added management and bureaucratic costs, which may be paid to maintain the investments over the long term. So we want to keep our costs low and we want to have the least complexity possible with our investments. And being overly diversified, being diversified over any reasonable number of companies can allow us to have too much complexity. Then the last con, there can be political and legal influences which change an investor's life. Rupert Murdoch is an excellent example of this. He became a U.S. citizen in 1985 because non-U.S. citizens were only allowed to own a maximum of 25% equity in any company which held a broadcasting license. His strategy essentially forced him to accept citizenship. Although this example is somewhat extreme, the same basic rule applies to all investors. Political and legal influences can be costly in multiple ways. Okay, so this is something that is very rare. There's not as many issues around the individual investor here, but this can be the case with larger investors with larger amounts of money. Now, what do I think, right? Maybe you came here for my opinion as to how I deal with diversification, how I diversify my portfolio, how I may not diversify my portfolio. Well, let me give you this, okay? I believe that the vast majority of what you have, right, the vast majority of what you invest should be in diversified groups of mutual funds, index funds, whatever it may be. I think diversification is useful. It helps to provide you good long-term returns, and it keeps volatility down over the long term. But you can still make returns that are going to be market-based returns, okay? So it's nothing that is far too negative over the long term. Now, that is for individuals, especially individuals who don't want to do a lot of research, don't care too much about picking individual securities. I think if you're going to just be the casual investor, then the casual investor doesn't need to worry too much about diversification, because the investments that you're going to buy are naturally going to be diversified because you're buying ETFs and mutual funds and things of the like. Just buy good ones, buy low cost ones, and buy indexed ones, and those are going to suit you the best over the long term. But what about individual companies, right? Buying individual stocks. Do I think it's important to diversify when you buy individual stocks? Absolutely not. I don't think diversification is especially useful when buying individual companies, okay? I think what's more useful when you're buying individual companies is understanding the company, understanding what you see over the long term in that company, right? Having a good basis for investment, understanding the fundamentals, and being able to project into the future the fact that that company is going to provide you returns, okay? Now, me saying that I don't necessarily believe in diversification of individual stocks doesn't mean that I don't believe in holding multiple individual stocks. Of course, I believe that you should hold somewhere between 6, 10, 12 individual stocks. I know today we talked about 25 to 30, but that's just a lot of due diligence that you have to do. If you can understand 6, 12 businesses very, very well, then it's easier to manage, and you can be very sure that your higher conviction names are going to provide you good returns over the long term, and you're not diversifying too much to where extra stocks are going to take away from the returns that you can make on your higher conviction names. So I wholeheartedly believe in not just holding everything in one stock, right? And I wholeheartedly believe that most of the things that you hold should be in diversified groups of companies. But if you are purchasing individual stocks, on top of your mutual fund, your index fund, your ETF investing, then that doesn't have to be fully diversified out. And it doesn't have to be where you have to understand a bunch of different things. Find some things that you understand. Find some companies that you understand, where you understand where they're getting their revenues from. You understand how their growth can be projected into the future, and own those, and add to them, and add to them, and add to them, and add to your high conviction names, and get out of names that you're not as convicted about. Okay, so I see both sides. I see what Warren Buffett and Mark Cuban are saying, because they're buying individual companies and they're just trying to understand those individual companies as best they can. That makes perfect sense, right? But if you're a casual investor, you need to save yourself from ignorance, right? It's a protection against ignorance, like Warren Buffett says. And ignorance is not always a terrible thing. You just have to have a general understanding of what you're invested in. You have to have a general idea of what a mutual fund is, an index fund is, what the costs are, things like that. But you don't have to understand every company within an index fund or mutual fund. Just buy the fund and continue to buy the fund over the long term. And it has proven to be a successful strategy. And it does help you to protect yourself against any ignorance that you may have about individual companies. But never get into buying individual stocks if you don't understand the companies, if you aren't willing to take a little more risk in that way. Because naturally, less diversification is going to be more volatility, therefore more risk, right? But naturally, if you own good names, it can provide you the highest returns, which is why Mark Cuban and Warren Buffett are some of the richest men in the world.